This is Nightly Business Report with Bill Griffith and Sue Herrera.
Oil slick prices are at the lows of the year as domestic crude remains in the grips of its biggest losing streak on record.
Trade talk. The U.S. and China are in discussions again, and that offered some momentary relief for investors.
Tax breaks. How much did New York and Virginia give up in order to get the second headquarters of one of the world's largest companies? Those stories and more tonight on Nightly Business Report for Tuesday, November 13th.
And we do bid you good evening, everybody. It was another volatile day for stocks, but the focus today was once again on oil, and for good reason. U.S. crude is in the midst of its worst losing streak ever. Prices today closed at their lowest level of the year. That's a stunning reversal from just a few weeks ago when the commodity was trading at a 4-year high. Back in early October, there was concern that a shortage would push prices to as much as $100 a barrel. But today, the concerns are about a supply glut. According to a new report from OPEC, major oil producers have been keeping their spigots wide open. And that report resulted in some domestic crude today falling another 7% to settle around $55 a barrel, making it 12 straight sessions of declines. Exxon and Chevron were two of the worst performing stocks in the Dow today, and oilfield services companies Halliburton and Schlumberger hit 52-week lows. And tonight, oil producers are in Abu Dhabi, and there is no doubt that prices are top of mind. Steve Sedgwick is there for us tonight.
Global oil markets continue to fall on Tuesday, despite the brief respite the markets saw on Monday. You've now got WTI and Brent trading in bear market territory, i.e. down more than 20% from their recent October highs. They actually rose in part on Monday on hopes that there would be less supply on the market. That came on the back of an oil meeting of OPEC ministers here in Abu Dhabi. But I'm afraid by Tuesday, the market was falling yet again. This follows President Trump tweeting that he didn't want Saudi Arabia and OPEC to be cutting production. Very tough for Saudi now as well, because they are seeing increased supply and concerns that there will be a supply glut and hence bigger inventories in early 2019. So they were hoping to get ahead of the curve and cut production to alleviate those concerns. And this at the same time as the US is showing record production. So then they would be ceding market position to those United States shale producers as well. A very tough conundrum for OPEC, a tough conundrum for Saudi Arabia. But as we speak, prices continue to fall. This is Steve Sedgwick for Nightly Business Report in Abu Dhabi.
And trade is the other issue investors have been keenly focused on. And today we learned that talks between the U.S. and China have indeed resumed. That thawing of tensions helped lift trade-sensitive stocks like Caterpillar. Elon Mui has more details.
Treasury Secretary Steven Mnuchin spoke by phone with China's top trade official. The two are expected to meet in Washington soon, and both sides are busy preparing for the big meeting between President Trump and President Xi later this month.
We are, again, talking with China, and I think that's very, very, very positive. You know, the president initiated a phone call with President Xi. We now know that we will, in fact, discuss trade at the G20 meeting in Argentina.
White House economic advisor Larry Kudlow has tried to keep negotiations on track, but not everyone in the White House agrees with him. Trade advisor Peter Navarro recently blasted Wall Street globalists for pressing Trump to cut a deal with China. Today, Kudlow has choice words for his colleague.
He was not speaking for the president, nor was he speaking for the administration. His remarks were way off base. They were not authorized by anybody. I actually think he did the president a great disservice.
China is not the only front in trade negotiations. The vice president met with Japan's prime minister in Tokyo today, promising to work together on trade, infrastructure, and national security. Tomorrow, an official from the European Union will be here in Washington. They're all hoping that by keeping an open dialogue, they can keep any tariffs away. For Nightly Business Report, I'm Elon Mui in Washington.
But the potential easing of trade tensions was not enough to offset the decline in the energy sector today. The Dow was also dragged lower by Boeing as new questions swirl around its latest 737 model aircraft. The result, a wild day of trading. The Dow range was 300 points. It fell 100 at the close to 25,286. The NASDAQ rose 1 cent. The S&P was down by 4.
And with these wild moves in the market, there may have been voices cautioning investors. There are many of them out there. The latest, though, is Bank of America's Merrill Lynch analyst who is advising investors to stay cautious because he says the big low for stocks has not arrived yet. So David Wright is the co-founder of the Sierra Funds. He agrees. And Frank Murtha is the doctor of psychology and co-founder of MarketPsych.com. They're both here to put this market sentiment into context. Welcome to both of you. Pleasure to have you here.
Thank you, guys.
David, I'm going to start with you. You agree with this analyst. I mean, that was a pretty strong statement. But you've been bearish for a while here. What is it that you've been seeing in this market that leads you to believe there's still more to come?
Well, the major indices in the U.S. have been peaking at different times. That somewhat occurs at a major top. But most importantly is the preponderance of new lows over new highs, 52-week new lows. And when you get a string like that, it's very dangerous.
Dr. Murtha, plenty of people have been saying to me with all these calls for a sharply lower market here, we keep hearing how a correction like that would be healthy. And they say to me, how is that healthy when I'm losing money? What do you say to them?
I mean, I tend to prefer markets that go up. I don't like losing money. Is it healthy in the grand scheme of things, taking a step back? Sure, sometimes taking a step back can enable you to take 2 steps forward.
But I mean, how does that work? It's not just a psychological amount. It is a market that doesn't go up forever. It has to pull back at some point to allow people to get in at better prices. Isn't that the idea?
Well, we're talking about laws of physics and we're talking about laws of markets. And they tend to track each other pretty closely, but not exactly. Certainly, it's been a fantastic run. I do think that the narrative has shifted some and that a pullback at this point is something that a lot of people are anticipating. So it's certainly not the worst thing in the world.
David, a lot of people are also talking about the fact that when some of those things that Bill just mentioned, the 20% correction being healthy and things like that, that applied to a market that is not structured the way that the market is now. Does that make a difference in the way that you view things?
I'm not really sure. The preponderance of ETFs now and ETF trading could be sort of a problem, a hidden problem. We don't know how they will be unbundled if and when the decline becomes severe. But, basically we're looking at a multi-month bear market probability here.
And if that's the case, David, what do you do? I mean, people sitting at home right now, they're hearing all these forecasts. The market has been very volatile in October and then now in parts of November. And they're probably wondering, what do I do with my money right now? You're in the real world trading out there. What do you tell them?
I would say put stops under your 5 biggest holdings. Look at your 5 biggest holdings that relate to equities and put meaningful stops under them and be sure to act with discipline.
Frank, talk to us about the psychology of this market at this point. And if you are a longer-term investor, what should you do to take some of the emotion out of your planning and out of your trading if you are an active trader?
Well, there's a few things that I think would be helpful for investors at a time like this. One of them is to really expand the scope of what you consider possible. One of the most important and pervasive biases that really hurt investors at times like this is to have a very narrow vision of what can happen. The fact of the matter is, it could be a gigantic pullback or not. Once you emotionally prepare yourself for that and recognize the large scope of possibilities, then you're prepared. Then the second thing you want to do is make sure you have a plan in place. And I mean something specific so you can actually act on it in the moment. Because once it happens, it's just too late to do that.
Yeah, it's too late when you're already in the middle of that there. David, what about those who hold bonds? There are a lot of people watching us right now. They buy those bonds for income. As stock prices go lower, bond prices tend to go higher as people shift from one asset to the other. What do you tell those folks at times like this when there is this volatility?
Well, when the stock markets of the world get really scary and fear does go across boundaries very quickly, inevitably global institutions will plow into the dollar and into U.S. Treasuries. So I'm looking for a very good season ahead, very good next 6 months in Treasury bonds. So for high-grade bonds, hang on. For high-yield bonds and emerging market debt, be very cautious.
All right, on that note, gentlemen, thank you. David Wright with the Sierra Funds and Frank Murtha with MarketSite.com.
Time to take a look at some of today's upgrades and downgrades. We begin with shares of NVIDIA tonight. They were upgraded to positive from neutral at Susquehanna, with the analysts citing opportunities in the growing artificial intelligence market. Price target $230. That stock rose another 5% today to $199.31. Southwestern Energy was upgraded to neutral from underperform at Bank of America Merrill Lynch. The analyst cited the recent rise in natural gas prices and cold weather forecasts. In fact, the firm sees the potential for a spike in nat gas prices because of tight inventory levels. Stock rose a fraction to $5.82.
And also at Bank of America, Best Buy was downgraded to neutral from buy. The analyst cites slowing industry growth and cost inflation. The price target is $70. The stock fell a fraction to $67.05. Perrigo was downgraded to hold from buy at Berenberg. The analyst cites increased competition in the generic drug market along with reduced pricing. The price target is $72. The stock was down a fraction to $65.39.
Still ahead, as home price growth slows, homeowners are still splurging. Starbucks is trimming its corporate workforce by 5%. The coffee chain said today it is laying off about 350 employees in marketing, creative product, technology, and store development. Most of the impacted positions are in the company's Seattle headquarters. Starbucks said that the restructuring is to streamline its business and spur growth. Shares finished down a fraction in today's trade.
Home Depot grew revenue and profits at its quicker than expected pace, even as the home improvement retailer said it faced tougher comparisons this quarter from a year ago, when its businesses got a lift from those devastating storms. The company's shares finished down just a tick to $179 even. Courtney Reagan reports from Long Island City, New York, on what drove the earnings beat.
While the U.S. housing market has showed some signs of slowing, Home Depot sales continue to outpace even the company's own expectations. In the home improvement retailer's third quarter, both the number of customer transactions and the amount shoppers spent increased. Sales to professionals like contractors again outpaced those to do-it-yourselfers, though DIY sales were also strong. Projects of $1,000 or more grew 9% in the quarter. The good enough to outweigh the negatives, like higher costs and lower hurricane-related sales compared to last year. Home Improvement CEO Craig Menear says that the home improvement outlook and environment are solid, even as sales of existing homes moderate, with mortgage rates rising along with home prices. Strong economic growth, historically high consumer sentiment, and unemployment near 50-year lows are all factors Home Depot calls drivers of home improvement, leading the retailer to raise its full-year forecast for both sales and profit. For Nightly Business Report, I'm Courtney Reagan in Long Island City, New York.
And Home Depot is not the only retailer reporting earnings this week. We have Walmart, Macy's, and JCPenney also on tap to offer fresh insight about the industry and the holiday shopping season. Greg Mellick is retail analyst at MoffettNathanson. He joins us tonight to talk about that. In fact, you've upped your forecast for holiday sales to 5% gain. Wow.
Well, we did it about a month ago, and frankly, jobs are strong. Consumer confidence looks pretty good, and the wealth effect should all be helping this holiday. So we think the consumer is going to be out to spend this year.
Who are going to be the leaders, do you think, this time around? I mean, sometimes it's the discounters, but Toys R Us isn't in existence anymore. So that's changed the landscape considerably.
We think it's these retailers that are getting multi-channel right. So we think Amazon's going to get their fair share. They should be about a third of retail growth in the fourth quarter. But Walmart, Target is really leaning into toys. We think that could help their traffic at least 1.5%. Just the Toys R Us closing and the share they could pick up there. So I think those are some names, holiday stocks that we think are well positioned. But I think, as you can see, some of our favorite stocks are actually the ones that aren't playing for holiday. They're really the home improvement names that are playing for next year.
Speaking of Walmart, they report this week. You think that's the most important report this week. Why?
Well, they're about 10% of U.S. retail sales, and they're, if you will, the best read on if the consumer is out continuing to shop. They've really leaned into multi-channel this year, and if they can keep traffic growing north of 2%, and with some inflation perking out there and tariff pass-through putting potentially some price pressure on the consumer, I think Walmart's a great bellwether to see whether the consumer can handle that inflation that could start to perk up if the tariffs keep on rolling in.
How are they faring against the likes of Amazon?
Well, they are holding their own this year in that they've worked hard. They've let their margins fall from nearly 8% to 5.5% in the U.S., but they've gotten traffic from negative to positive over the last few years, and that's critical. Amazon, though, don't count them out. They've got 70 million plus households signed up for Prime. They're now shopping, we think, on our survey more than 30 times a year. So we think overall Amazon is still taking a good probably $60 billion of retail dollar growth this year. That's about a third of the growth.
Tomorrow we get the Consumer Price Index. Last Friday we had the producer, the Wholesale Price Index, which was the strongest in 6 years. Do you think retailers will be able to pass on these price increases? Do they have the pricing power right now?
I think the answer is some will and some won't. And that's one of the things we're really looking for in this earnings season and holiday is who has it. In our view, and it really matters even more into next year, if the tariffs stay where they are, we go to 25%, we think retail earnings growth could be cut in half from 8% to 4%. And that's even assuming they could price through about 60% of it. We think the home improvement names and auto parts are better positioned to pass through. And we think companies like Bed Bath & Beyond, Dollar Tree are some of the ones with more pressure in terms of being able to pass through inflation.
Very good. Greg Medlick with MoffettNathanson. Thanks again for joining us tonight.
Thank you.
Tyson Foods takes a hit from trade disputes, and that's where we begin tonight's market focus. The top U.S. meat processor said the trade war has resulted in lower prices and larger supplies, which caused it to miss quarterly revenue estimates. Tyson says it is not currently shipping beef, pork, or poultry to China. The stock fell 5.5% to $58.17. Advance Auto Parts raised its full-year sales forecast and reported better than expected third-quarter results. The auto parts retailer cited stronger demand. Analysts say the results show the company's multi-year turnaround is taking hold. The stock rose more than 10% to $184.72.
General Electric now plans to cut its stake in oilfield services provider Baker Hughes sooner than expected. The move will reduce GE's stake in the company to just above 50%, and it will raise about $4 billion in cash at current market prices. As we reported, CEO Larry Culp is now focused on reducing that company's debt load and raising cash levels. Shares rose 7% today to $8.61. Cannabis firm Tilray saw its third-quarter revenue rise more than 85%. But on the bottom line, its quarterly loss expanded from a year ago as a result of higher operating expenses. The company spent more to fund growth at home and abroad as it positions itself to take advantage of the increasing legalization of recreational use of marijuana. Word of the wider loss, though, resulted in volatile stock moves in the extended trading session tonight.
Amazon has made it official. Its massive second headquarters project, which was supposed to transform whatever city Amazon chose, will now go to 2 cities instead, New York and Arlington, Virginia, as we've reported. But as Scott Cohn tells us, the decision raises at least as many questions as it answers.
The competition was intense.
All hands on deck.
Sometimes a little weird.
We might have to start with going to the state to see if we can get the legislature to change the name to Phoenix, Arizona.
238 cities from across the continent entered the bidding for 50,000 jobs and $5 billion in investment. The result, a tie.
This was a fierce competition. I think it's exciting for Amazon. I know it's exciting for the state of New York.
This certainly consolidates Queens as a great economic capital and consolidates New York City as a great international tech hub.
New York's Long Island City neighborhood gets half the prize, a nod to a strong tech workforce. The other half goes to Northern Virginia, a strong workforce as well, and a strategic location wedged between Reagan National Airport and the Pentagon.
It is a performance-based incentive package that we put on the table, so the return on our investment will be very good.
And a consolation prize to Nashville, Tennessee for its strong economy. It'll get a 5,000-employee operations center.
This is the largest jobs announcement in the history of the state of Tennessee. and 5,000 jobs that will average, I think I'm safe to say, $150,000 in salary. Said it now so they can't take it back.
Amazon gave no official explanation for the split decision, but in the end, no one city in North America could provide everything the company wanted. Most important, 50,000 skilled workers in one place. The move also allows the company, which made $177 billion in revenue last year, to make the most of government subsidies. $1.5 billion from New York State, $600 million from Virginia, and more than $100 million from Tennessee.
We're seeing more than $2 billion in subsidies being offered by Virginia and New York for an expansion the company had to make.
All the locations will have work to do to make way for Amazon, like infrastructure improvements. Meanwhile, for the 235 cities that didn't make the grade, like Boston, Chicago, Dallas, plenty of questions about what they did wrong, how they can do better, and why they got into this battle in the first place. For Nightly Business Report, I'm Scott Cohn.
And from big business to small, confidence among Main Street businesses owners remains near record levels right now. They cite high profit trends and historically low inflation. But the survey also showed that small businesses are concerned about the tight job market. They say that they have not experienced this level of labor market constraint since the late 1990s. Kate Rogers spoke to one owner who's feeling that pressure.
Rod Dion found his business particularly hard hit during the Great Recession. His Albany, New York-based company sells office furniture and provides interior design services, not in particularly high demand as the economy was taking a nosedive.
I used to joke actually that I owned one of the top 5 things nobody needed during the recession.
Today, his business has 9 staffers as the economy continues to chug along, but not without a price. Dion has had to get more aggressive with his recruiting tactics. He's increasing pay for new interior designers because workers with the skills he's looking for are hard to come by.
Over time, I have seen the salaries of what I'm paying the designers has increased by about $10,000 since, say, 2012. Along with that, there's other creative ways that we compensate them with bonuses and commissions and things like that. So the package has gotten more attractive as business has continued to improve.
The strong economy has cut Dion's business and many others in 2 ways. New customers have helped to boost his bottom line, but it's becoming difficult to find workers to support that new business. Labor quality has been the top concern for small businesses polled in the National Federation of Independent Businesses monthly optimism index for more than half of the year, outpacing taxes and government regulations. Last month, the percentage of owners raising wages hit a new record. To combat competition, Dion's thinking outside the box. He offers to make principal payments on student loan debt of up to $300 a month, an attractive idea for younger employees in particular.
I haven't had anyone turn it down. Because I think student loan debt is a real issue. I think there's a benefit for them, and I think they quickly recognize that as a interesting form of compensation.
For Dion, keeping his interior design business thriving requires both innovative designs and hiring practices. For Nightly Business Report, I'm Kate Rogers.
Coming up, Tesla powers up.
With thousands of robots working nearly 24 hours a day, Tesla believes it has found the key to driving down the cost of an electric car. I'm Phil LeBeau in Sparks, Nevada. We'll go inside Tesla's Gigafactory when Nightly Business Report returns.
As Tesla ramps up sales of its latest vehicle, the Model 3, the company is also expanding its battery production. Tesla's Gigafactory now builds more batteries than all other battery plants in the world combined. Phil LeBeau takes us inside the plant in Sparks, Nevada, for an exclusive look at Tesla's drive to push down battery costs.
Tesla's massive Gigafactory is getting bigger and busier. Thousands of robots and more than 7,000 workers are building battery packs and drive units for the Tesla Model 3. As sales of the electric car grow, Tesla is planning on more lower-priced models, which means building battery packs at a lower cost. A challenge Tesla's automotive president is confident the automaker can overcome.
The battery remains the must the costliest part of the vehicle. So it's really, really important that we improve our efficiency and the design so that we make them more affordable.
Tesla is already well ahead of competitors when it comes to battery cost, partially because of the size and scale of the Gigafactory. But analysts question how long those advantages will last.
Do I think they have an advantage? I actually really don't think they have a scale advantage for very long, I guess I put it that way, because a lot of scale from battery companies is coming very, very soon.
Other automakers from GM to Nissan to Mercedes are planning to build and sell more electric cars, especially 5 or 6 years from now. So there will be greater demand for the raw materials that make up batteries, like lithium.
That concerns me a bit, because if you're gonna get a mine to start producing at capacity in 2022, you need to be investing in it today, investing in putting shovels in the ground today. And that is not happening at a pace that needs to for the EV industry to really take off in that time period.
Tesla is confident it will have plenty of raw materials to continue expanding battery production as the industry continues to build more electric cars and Tesla continues to push to deliver more lower-priced models. Phil LeBeau, Nightly Business Report, Sparks, Nevada.
Quick update on that pink diamond we told you about a few days ago, the unusually large gemstone with the highest grade of color intensity sold at Christie's today. You ready? More than $50 million. That's a record for that pink diamond.
Beautiful. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Don't get any bright ideas. Have a great evening. We'll see you tomorrow.
It's a neutral. It goes with everything.
Yes, it does.